And you spend hours watching ads, testing websites, or filling out those useless online surveys. I mean, they only pay a few dollars anyway. What's the point? Instead, I'm interested in the big bucks, so I'm going to be grouping all my favorite online side hustles into 4 tiers. Of course, the faster you progress through those tiers, the more money you'll be able to make. I'm talking about generating at least $1,000 a day if you reach the top tiers. So if you're up for the challenge, click the like button to let me know. So let's start with the base tier. These are things you can just get on and start and do straight away without any skills. They're all about generating that fast money. So the first idea I have for you is flipping Instagram theme pages. These are pages that are focused on specific subjects. When I first heard that you can make money from flipping these, I was quite shocked. Back in my day, I had to buy actual physical products like cars, but now this actually makes complete sense. Just think about it. When was the last time you scrolled on Instagram and didn't see a sponsored post? They're everywhere, aren't they? This just shows brands are putting loads of money into Instagram adverts, which makes the pages more valuable. If I were you, I'd only buy pages with active followers and continue to grow them by posting regularly. I would pick a car theme page, as I used to race cars myself, so I know the niche has a big demand from advertisers. Here's my old crash helmet, custom painted with my logo, Tilbo Flying 7. Great days. Next up is selling items on Facebook Marketplace. This is such a great way to sell things without having to deal with postage or selling fees. Recently I had my backyard ripped up as we're having a total redesign, and I was left with 400 heavy concrete slabs. Now I could either pay to have them taken away and dumped for me, or find some sort of alternative option. And you know me, I don't like wasting money, so I put them up for sale on Facebook Marketplace. I thought it's got to be worth a go, hasn't it? Later that day, my phone exploded with messages from people all over my area asking if they could come and get some of my slabs. I couldn't believe it. People came and removed my garbage and I didn't even have to lift a finger. The best part of all though, I made an extra $650 that day. A more long-term example is selling vintage clothing online, and one of my friends does exactly that. She finds them through poorly advertised eBay listings, and you can do a similar thing by using a website called Typo Hound. This is really cool because it looks through all of the misspelt items on eBay, so you can buy with a lower competition and get a great bargain. She cleans the clothes and does any repairs needed, then she dresses her mannequins so she can take great photos, and she post them on social media. You know what? It's so successful, she struggles to get enough clothes. So if I can sell dirty paving slabs and my friend can sell second-hand clothes, I'm sure there is something in your house that you can sell and start making a profit. Next up is the mid-tier. This is all about going out and selling your skills. These online side hustles require more upfront work to begin with, but as you develop your skills, you'll be able to charge a lot more than the average person, as you're providing more value, and this of course equals higher pay. One of the things that comes to mind is being a social media manager for small businesses. I've actually just hired someone to help me post more on my Instagram. That reminds me, if you haven't already followed me, drop me a follow at Real Mark Tilbury for regular posts and updates. The person I've hired is great, as she's able to look at the graphs and the numbers and tell me how everything's performing. All I have to do is supply the content, reply to you guys, and the rest is all taken care of. I found my social media manager through her own page. I could see how passionate and talented she was, and after a quick chat, I knew I had to hire her. So if you want to stand out, it's probably a good idea to imagine you are your first client by marketing your own social media accounts. If you spend time learning how to maximize your accounts, then you'll be able to offer your future clients a much better service. As you start working with more businesses, you can slowly up your prices, and before you know it, you'll be making more than $150 per day. Over 600,000 new businesses are started every year in the USA, and guess what they all need? A logo. So if you're a creative person, why not learn how to use photo editing software? Then you can use your skills to make money online through freelance graphic design. For this type of work, no one cares about your school grades. Instead, your past work acts as your qualifications. So it's really important to build a great portfolio to seal the deal with your clients. When hiring someone new, I feel more comfortable if they offer their services for free, as it reduces the risk for me and gives them a way to build their portfolio portfolio. I know that working for free sounds like a waste of time, but it's a great way to check out the competition and also see how to price your services. Once you have a solid portfolio, you can either go directly to your clients or offer graphic design services on websites like Fiverr that already have a huge marketplace. If you're good, there's no reason why you couldn't be earning $150 per day in your spare time. How about this next one? When everything locked down in early 2020, my son's girlfriend had a great side hustle as an online tutor, and it's still going strong today. Before the illness happened, I probably wouldn't have added this one to the list, as most people wanted in-person tutors. However, I really think the world has changed. If you're talented at a particular subject, it may be a great option to teach it online. She advertised her services on Facebook, and before she knew it, her DMs were full of potential clients. So if you find the right Facebook groups, the demand is sky high. The great thing about doing it online is that you cut out all the travel time, which means you can work with more people and earn more money. You also don't have to just work for people in your local area, as you can teach anyone anywhere in the world. If you're doing this in your spare time, you should be able to expect a good $50 plus per day. If you enjoy writing, then maybe you should try copywriting. This is the art of selling a product through writing. This is like being a salesperson, but reaching out to everyone. You can write sales pages, ads for Facebook, email newsletters, the list goes literally on. And the more you specialise in one specific area, the more you learn. I first learned about the art of copywriting when I read an amazing book called Breakthrough Advertising by Eugene Schwartz. This book currently sells for over $200 a copy, and it's considered the holy grail in the copywriting world. This just proves how in demand copywriter services are. If your writing is able to convince lots of people to buy, then you're able to justify charging really high prices, as effectively you're paying your own wages. This couldn't be more true than for the guy who took 3 weeks of studying to come up with the winning concept for a Rolls-Royce advert. The final headline read, "At 60 miles an hour, the loudest noise in a Rolls-Royce comes from the electric clock." It took him a while, but he managed to find a golden nugget that people still remember to this day. His skill with copywriting made him a small fortune. Now, no business can survive long without a good website these days, and most people are lacking the skills or the time to build one themselves. So if this interests you, then why not sell your web design services? I know 2 teenagers that decided to take up web design, and they went in 2 totally different directions. One decided he'd use website builders such as Squarespace, which means he only had to sort of edit really simple templates to build a basic site for his clients. The other decided to code bespoke websites from the ground up for larger clients that wanted something more original. Now, both are very successful at what they do, but they serve entirely different markets at different price points. You'd get paid more for a bespoke site, however, this takes a lot more time to learn.
Years ago, I set out to answer this question by creating a video where I invested $100 into 5 different things. Today, I'm going to compare the results from those 5 investments that you can make from your laptop and try to finally answer the question once and for all. We're going to be using this grid to judge each one in these categories. First up, learning curve. This is how long it takes to learn the ins and outs of each method. Ideally, we want this to be as short as possible. Next is passive income potential, which is how much money an investment can earn for you passively while you still own it, without needing to sell it. Then there's tax efficiency, which refers to the specific tax advantages or benefits available for each type of investment that can help you pay less tax. After that, we have risk level, which is about how likely you are to lose money and how much the investment's value might go up or down. And finally, we're looking at the results. This is where I'll reveal my percentage return over the last 4 years and exactly how much my $100 investment is now worth. Before we jump in, please remember, I'm not a financial advisor. I'm just sharing my own results and strategies that have worked for me over the years. Please also do your own research. Okay, first up is individual stocks. Individual stocks give you the chance to own a piece of a company you believe in. This can be really exciting because you're directly investing in businesses that you think will grow or succeed. For learning curve, I'm going to say this is high. If you want to be successful picking individual stocks, then it's not just a guessing game. You'll need to dig into the nitty-gritty of a company's fundamentals. This includes looking into the financials, who's leading the company, and how well known the brand is. When I invest in individual stocks, I look through income statements, balance sheets, and cash flow statements. So when I invest in a stock, I'm in it for the long haul, which means at least 2 to 10 years. A great way to learn how to do this is by using an investing app with a demo account, which lets you play around with fake money until you're confident with your strategies. For passive income potential, I'm going to say this is good. You see, when you own a stock, there are two ways you can make money. Firstly, if the price of the stock goes up during the time you own it, you can sell it for more than you paid. Secondly, you can receive dividends. Dividends are regular payments to shareholders. Not all stocks pay dividends, but if they do, this means you can receive money without ever selling your stock. This is essentially passive income. Now, for tax efficiency, this is great. If you use the right accounts, then you can reduce your tax burden. In the UK, these are called stocks and shares ISAs. You can set one up on most investing apps, and any profits you make are safe from taxes. In the USA, there's something similar called a Roth IRA. These accounts work like a shield, protecting your profits from the taxman. While there are different rules depending on where you live, the idea is the same. Please bear in mind that I'm not a tax advisor, and you should do your own research as everyone's circumstances are different. So what's the risk? This is definitely high. Back in 1995, during the dot-com boom, I got lucky and picked a few great stocks. I sold them at the right time and made a lot of money in a short period. But when the bubble burst, some of the other companies I'd invested in, ones that cost me very little, went out of business completely, even though I ended up making money overall. It just shows how risky investing in individual stocks can be, especially if you put all your money into just a few companies. If they fail, you could lose everything. So let's look at how much my $100 investment is now worth. Let me refresh your memory. Here's what I invested in.
So I'm going to throw a dart at the board, and as you can see, I randomly selected 20 different stocks, and wherever the dart lands, that's what I'm going to invest in. Now I've just got to put on a blindfold. Okay, here we go.
Oh, you hit it.
Right, let's see what we got. And we've gone into Samsung.
That investment is now worth $67.66. But don't forget my dividends. Over the 4 years, I made 10 cents. So that leaves me with a total of $67.76. That's a negative 32.34% return. This example perfectly shows how hit or miss individual stock investing really is. That dart could have just as easily landed on Apple, Microsoft or Nvidia. So let's have a look at how much I would have made if that dart had landed a bit differently. A $100 investment in Apple 4 years ago would now be worth $170. The same investment in Microsoft would be $188. And, drum roll please, Nvidia would be worth $908. Those stocks have boomed in recent years, and luckily I have some of those in my personal portfolio. But this just goes to show you can't just leave individual stock investing down to luck. You have to be strategic with your stock picks, and even then the market is unpredictable. If you want to try this out, just download Trading 212. It's a great app for beginner investors because it lets you use a demo account to practice trading with fake money. This way, you can learn how it all works without risking any real cash, just like I mentioned earlier. It also lets you set up a stocks and shares ISA if you're in the UK, which protects your investment returns from taxes. But again, I'm not a tax advisor, so please do your own research as everyone's situation is unique. Trading 212 also lets you buy fractional shares, which means you don't have to buy a whole stock. That's how I was able to own just 0.07 of a Samsung stock, instead of having to buy an entire share. As I was going to mention Trading 212 anyway, I reached out to see if they'd be interested in sponsoring this portion of the video. They agreed and are offering a free fractional share worth up to £100 to anyone that uses the code Tilbury when they create an account. Plus you can get more free shares by inviting your friends. Both of you will get a free share as long as they fund their account. I'll leave the link in the description if you're interested. Second is a real estate investment trust, otherwise known as a REIT. I know this one sounds pretty complicated, but it's actually quite cool. Imagine your friend collects $100 from 3,000 people, giving him $300,000. He then uses that money to buy a property, rents it out, and shares the rental income with all 3,000 people who helped him buy it. That's a simple way to explain a REIT. It allows anyone to invest in properties without needing to buy one themselves. Think of it like you own the front door, someone else owns a window, and a few others own the bricks, which means together everyone owns the entire property and shares in the profits. For learning curve, I'm going to say it's moderate. And that's because getting started with REITs is much easier than buying physical property. It's not like you need a huge down payment or a mortgage, and there's no need to deal with agents or solicitors. However, you do need to understand how REITs work. They own things like offices, shopping centres, apartments, hotels, and much more, and they get their income through rent. For passive income potential, I'm going to say this is great. REITs are well known for paying high dividends. This is because the law says they have to pass on at least 90% of all their profits to investors. So as long as the REIT is doing well and its properties are rented out, you can earn a steady stream of passive income. Most businesses sign long-term leases on their commercial properties. Therefore, most of the time, income is pretty stable and reliable. But of course, just keep in mind that your earnings depend on the REIT you pick and the types of properties it owns. For tax efficiency, I'm going to put this down as great. This is because in many countries, REITs offer great tax benefits. For example, in the UK, you can hold REITs in a stocks and shares ISA, which means you don't have to pay taxes on your profits or dividends. In terms of risk, I'd have to say this is medium. REITs are generally less risky than buying a single property because they invest in multiple properties, spreading out the risk. However, they're not risk-free. If the real estate market takes a downturn, or if the REIT struggles to keep its properties rented, you might see both a drop in dividends and the value of the investment. So what's my investment worth now? Let's flash back to me making the investment 4 years ago.
As I'm in the UK, I'm going to use the Trading 212 website to put $100 into a similar REIT.
Ready for the moment of truth? Looking at my investment now, I can see it's worth $98.59. So that's a small loss of 1.41%. This shows that even though REITs are normally more stable than individual stocks, they're not guaranteed to perform well. My REIT likely underperformed because it invested in commercial real estate, which struggled during the pandemic. But that's not the end of the world, as I made $11.93 back in dividends, meaning I'm actually $10.52 up. So that's 10.52% up. Third is cryptocurrency. Imagine a form of digital money that isn't controlled by any government or bank. That's what cryptocurrencies like Bitcoin and Ethereum are. These currencies run on the blockchain technology, which makes them secure, transparent, and almost impossible to counterfeit. Cryptocurrencies have created massive wealth for some people, with Bitcoin being the best performing asset of the last decade. But on the flip side, it's highly volatile and people have also lost fortunes. That's why I describe crypto as part investment and part speculation, and not for the faint-hearted. For learning curve, I'm going to say it's moderate. Crypto might sound complicated, but I'll break it down for you. First, you'll need a wallet. This is where you store your crypto. Think of it like a digital piggy bank, and there are different types. First are online wallets. These are easy to use, but you'll need to protect them with very strong passwords. Second are offline wallets, like hardware wallets. These are the safest because they're not connected to the internet. Next, you'll need to pick an exchange to buy and sell your crypto. Some popular ones are Coinbase and Binance. These platforms make it simple to trade, but make sure to choose a trustworthy exchange to avoid any issues. Then there's tokenomics. This just means understanding how the supply and demand of a coin works. For example, Bitcoin has a limited supply, which is why it's often called digital gold. For passive income potential, I'm going to also say this is moderate. Unlike stocks or REITs, crypto doesn't pay dividends, but there are ways to earn passive income. The first is called staking. This is when you lock up your crypto, like Ethereum, to help the system work and process transactions. In return, you get paid rewards, kind of like earning points for helping out. The second is yield farming. This is when you lend your crypto out to others and earn interest on it, similar to how a bank pays you interest when you save money with them. These methods can generate decent returns, but they do come with higher risks. If the coin's value drops or the platform you're using gets hacked, your income could disappear along with your crypto. That's why I personally don't mess with any of this and just hold mine on a Ledger wallet. For tax efficiency, I'm going to have to say this one is poor. Taxes are a tricky part of crypto investing. In many countries, even swapping one cryptocurrency for another counts as a taxable event. And if you earn staking rewards, those are also taxed as income. You also can't hold crypto in tax-advantaged accounts like ISAs or Roth IRAs, which makes it less tax efficient than stocks or REITs. In terms of risk, I'd have to say it's very high. Crypto is one of the most volatile investments out there. Prices can soar 1,000% in a year, but they can also crash just as fast. Personally, I just invest in Bitcoin and Ethereum as they're more established and often referred to as blue chip cryptocurrencies. Smaller altcoins can be far more risky. You've also got to be cautious of scams. Since crypto isn't regulated, if someone hacks your wallet or tricks you into sending your coins, there's no way to get them back. So keeping your crypto safe is just as important as learning how to invest in it. So what's my investment worth now? Let's rewind to when I made this investment 4 years ago.
So I'm going to jump onto the most popular Bitcoin app, which is called Coinbase, and invest my $100 in Bitcoin and forget about it.
Ready for the reveal? The $100 I invested in Bitcoin is now worth $652.24. That's a return of 552.24%. Now, I know what you're thinking. That's insane, and it is. But I have to stress that this kind of growth is not typical. Bitcoin has been the best performing asset of the last decade, but most cryptocurrencies don't see these kinds of returns. Many lose their value entirely. In my opinion, crypto is exciting and the technology behind it has the potential to transform industries. However, it's not for everyone. It's highly volatile, speculative, and requires a strong stomach to handle the wild price swings. Just remember, crypto is all about high risk and high reward. So if you're going to dive in, make sure you're doing your research and investing wisely. Fourth is gold. This is one of the oldest and most trusted ways to store and protect wealth. Gold is often called a safe haven because it's a great way to protect your wealth during uncertain times, like when inflation is rising or the economy is struggling. For learning curve, I'm going to have to say it's low. Learning how to invest in gold is pretty simple. You have two main options. First, physical gold. This includes gold bars and coins. Many people also think you can buy gold jewelry as investments, but you'll often pay more than the gold is actually worth because sellers add a markup for their craftsmanship. For this reason, I personally stick to gold coins. Just bear in mind, if you pick this option, then you'll have to store it somewhere safe. Second is gold ETFs. These are funds that let you invest in gold without physically owning it. For example, in the UK, you can use Trading 212 to buy shares in something like the iShares Physical Gold ETF. It's quick, easy, and you can buy or sell it with just a few clicks. Passive income potential is absolutely zero. Unlike stocks, REITs, or crypto, gold doesn't pay any passive income. It's not an income generating asset. It's purely a store of value. For tax efficiency, I'm going to put this as good. If you buy physical gold like gold coins or bars, the tax rules can be a little tricky. For example, in some countries, certain gold coins like the UK's Gold Britannias are considered legal tender, which means you don't pay capital gains tax when you sell them. However, this doesn't apply to all gold coins or bars, so you'll need to check the specific rules in your country. For gold ETFs, they're generally more straightforward. In countries like the UK, you can hold them in a stocks and shares ISA, which makes any profits completely tax-free. Interestingly, physical gold has another unique advantage. It can be used to transport wealth across borders discreetly. That said, this approach comes with risk, such as theft or legal restrictions on transporting large amounts of gold across borders. While it's not something I'd necessarily recommend, it's worth mentioning as a unique aspect of owning physical gold. In terms of risk,
A multi-millionaire by the age of 35, and how you can do the exact same thing. So I've got a simple question for you. Do you want to be rich and have the freedom that comes with being financially stable? Many people do. Why do you think there's so many get-rich-quick schemes out there? Most people though, unfortunately have a lottery mentality. They're just waiting for the magic fairy to come down and hand them $1 million. Do I look like the magic fairy to you? If the answer is no, and I really hope it is no, then smash that thumbs up button and subscribe to the channel. The truth is, lots of people think that winning a chunk of money will make all your problems just disappear. But they'll be in for an absolute shock. Without the correct investing and mindset strategies, it will be all gone, and in no time you'll be back to square one. You need a solid, consistent investment plan which gradually builds your wealth over time. Long-term investing will give great returns. When I was younger, I always wanted to be a race car driver. I just loved everything about cars, but I didn't have enough money to pursue my dreams. But as I started building up my investments, it allowed me to race in multiple championships and win countless trophies like this. I even got my helmet here, look. You sometimes see it at the back of the shots. How cool is that? My investments even allow me to spend time having fun making these YouTube videos, like the one you're watching. I don't currently make any money from this channel, and you can sit back and relax because I'm not going to try and sell you something at the end either. There are so many different investments out there. It's super easy to get distracted by the next shiny object. It's also confusing when you have someone telling you that this is the best thing, the latest and greatest, and if you don't invest, you could end up losing thousands. You may have heard of Bitcoin, penny stocks and short selling, but I found the key for me is not to get overwhelmed and distracted by the latest trends. Now, you've got to face it, you are never going to be an expert at everything, and by consistently changing your investing strategy, you ultimately end up with less money, and at some point you're going to make a big mistake. I have nothing against experimenting, but I've kept my main investments very consistent over the years, and I make sure to only invest large sums of money into things that I understand completely. I'm not going to pretend that I have all the answers, but I am going to be completely transparent about everything I've done that's helped me acquire a multi-million-dollar net worth. I'm a businessman and not a financial advisor, so I don't consider this financial advice. It's just what I've done and it's worked for me. First of all, you need to create more disposable income. At the end of the day, you need money to invest, and the more money you have, the better, especially during your 20s and 30s. Now, lots of people will say to you, save, save, save. Don't go out with your friends. Don't drink that overpriced coffee. Don't buy that nice car. I don't completely agree. Of course, saving is a big part of this, but you have to enjoy your life. There's really no point making yourself miserable just for the sake of saving an extra few dollars. You should focus most of your time and energy on increasing your income. You can do this by learning new valuable skills, having a side hustle, or building a scalable business. You don't have to settle for money you get from your 9-to-5 job. You need to be focusing your time on finding ways to supplement or replace it. When I was in my early 20s, I realised my income as a carpenter, earning less than $3 an hour, was never going to give me enough money to invest. It hardly even paid my bills. I needed to find a way to dramatically increase this, and this is when I started my journey into the business world. Investing and business really work hand in hand. The saying is very true. The more you learn, the more you earn. And most importantly, the more you can invest. Be really aware of your lifestyle and make sure to keep it in check. Just because you're earning more doesn't mean you should be spending more. Think of someone like, say, I don't know, Ed Sheeran. He has a huge amount of money, yet he keeps his lifestyle in check. He still enjoys the little pleasures of life. If you were happy making, let's say, $40,000 a year, and you managed to increase your income up to $100,000 a year, that means you've got an extra $60K. This should be going straight into a high interest savings account and then into your investments. You know, you don't need to be spending it. Well, there is one slight exception, and that's stage number 2. Pay off all your high interest debts. If you have student loans, credit card bills, or even a payday loan, then these are pulling you down. They're destroying your credit score, which ruins your ability to take advantage of good loans. By paying off these high interest debts first, you'll actually save more money than you could ever hope to make elsewhere. The next stage is to create a freedom fund. This is my name for an emergency fund that puts the power back in your hands. This freedom fund consists of 3 to 5 months of living expenses. It protects you if you decide to quit your job, as well as a lot of other situations such as recessions, depressions, or even worldwide epidemics. Okay, so you've increased your income by learning a valuable skill, or maybe invested in your own business. You've kept your lifestyle in check, you've paid off all your loans, and you've created the freedom fund. Now, and only now, is the time to start looking at other options. Let's start off with the lowest risk option. Index funds. An index fund is a collection of investments that you can put your money into and own a percentage of the entire thing. This gives you a fantastic diversification and protects you from poor stock choices. For example, let's say you got $1,000 and you invest it in, I don't know, let's say Apple stock. As they're a big company, right? They're going to be safe. As soon as your money goes in, the company takes a turn for the worse, causing the stock price to crash. The result could be that you lose the majority of your investment. This is where index funds come in. Instead of owning just Apple stock, you could take that $1,000 and invest it in something like the S&P 500, which gives you small shares in Apple as well as Microsoft, Amazon, Facebook, Visa, Disney, and many more. You're a shareholder of all these major companies. Now, if something happened to Apple, it would be balanced out by the other investments in your index funds. Now, lots of people will try and convince you that a mutual fund is superior. A mutual fund is very, very similar to an index fund, except it's controlled by a very smart person whose job it is to pick the stocks in the fund. The purpose of a mutual fund is to try and beat the market and get better results for the investor. However, in the vast majority of cases, you'd be much better off putting your money into a simple index fund with less risk and often a greater return. This is because index funds charge extremely low fees. The S&P 500 charges 0.07% annually, and mutual funds charge high fees between 1 to 2% of your account balance annually. If you invested $10,000 into a mutual fund, then $200 would go straight into that fund manager's wallet every single year, even if he caused you to lose money through poor stock choices. On the flip side, if you had the same amount invested in the S&P 500 index fund, then only $7, yes, just $7 would be leaving your account annually. This is because index funds are passively managed and therefore don't have to pay a manager who may or may not be doing a good job. For long-term investments, I love using Vanguard index funds, as I like these. They're so easy to use. I'm not affiliated with Vanguard in any way. I just like the way it works. I also like to mix it up a little bit with some international funds and bonds to diversify my portfolio even more. The older you are, the more bonds I recommend you invest in. And I don't mean James Bond either, although he is pretty cool. The investment method I put the majority of my money into is real estate. I am much more of a real estate guy than a stock guy. I like real investments I can feel and touch, but I appreciate that it can be hard to buy properties with little money, but it's certainly something you should be saving for. My first property was a 1-bedroom apartment and I loved it. It was mine. It cost me around $50,000. And when I moved out, I decided to rent it $500 a month. I had this property for around about 10 years, and when I sold it for $150K. And after this, I was obsessed with the money that we could make from real estate. Now, this is a good time to decide which type of investor you are. The first type is a capital gains investor. This is someone who likes to buy low and sell high and pocket the difference. These are investors that are interested in buying houses of auctions, or you may have seen the signs outside advertising that
ideas and ambition, but without action, the life you've always dreamt of will start to fade away. Every day you wait, the more time you waste, and if you're not careful, your life will start to look a little something like this: flat, predictable, and totally uninspiring. This is the reality for most people, spending the past 5 years in the same job with maybe a couple of pay rises if you're lucky. You can even see after these pay rises, the line doesn't improve that much, and sometimes even goes down. This is because the more people earn, the more they tend to spend. The worst part of all is that this lifestyle pattern has become normalized by society, telling you that you're lazy and don't have what it takes to be successful. But even if this has been you for the past 2, 3, 4+ years, it doesn't have to be you this year. I don't believe you're lazy. You're just trapped in a system designed to keep you spinning your wheels on a flat line, convincing you that slow progress is the only way. So what you're feeling isn't laziness, it's frustration with a path that was never designed to help you thrive. Today's video is all about my 5-stage process to escape this trap and start creating some real momentum in your life. So let's get to it. Stage 1 is called stagnation, and I'd imagine that is likely where you are right now. The reason you feel like you've been thrown in at the deep end without any preparation or guidance is because that's exactly what's happened. You leave school and get your first job and that's it. You're left to your own devices. So you play it safe by sticking it out in the same job, taking 0 chances. If you stay in this stage too long, you risk becoming a debt slave where your income barely keeps up with your monthly expenses. Right now, the national debt clock is sitting at $36 trillion and increasing by the second. If this doesn't prove that our society is built on debt, then I don't know what will. People are owning fewer houses, fewer cars and fewer luxuries as the trend of renting instead of owning grows. This isn't just happening because times are changing. The elite have made their plans clear with something called the Great Reset. This aims to shift power away from people by depriving them of ownership and controlling it all themselves. Imagine the government owning your home and then letting someone else live there whenever you're away. This is the future they want, and it means escaping society's trap will be nearly impossible. They've sold us the lie that money doesn't make you happy. This was created by the rich to control the poor, keeping us dependent on state pensions that barely cover anything. In reality, money equals freedom, and freedom equals happiness. The rich are just going to keep getting richer, so why not just join them? If you can recognize this stage early, then you can take those calculated risks to get out before it's too late. Don't be part of the 58% of Americans living paycheck to paycheck, which I reckon will increase over the next few years. The first action you take is the most important. Start by gaining full control of your finances. Track every dollar you spend and be honest about what's essential and what's a luxury. Use this awareness to automate your savings so you consistently put money aside each month, no matter how small the amount. At the end of the day, even your Xbox is smart enough to save your game progress, so why not save your funds? The next stage is called ignition. Now, believe it or not, more than 50% of people never even get to this stage, which means this is when you might start to see a difference between you and your friends. At this stage, you're doing everything you can to break out of stagnation, but it's pretty hard because you've got a couple of things that are holding you back. First is your friends. They won't always like your new attitude, as it forces them to either change themselves or be left behind. Both of these things are very painful. So instead, they will try to drag you back down to their level, as that's the easier option. I'm sure you've experienced this before. When you tell a friend about one of your achievements, they don't seem that happy for you and try to shift the conversation to be all about them. The second issue you're going to face is inflation. Keeping all the money you save in the bank will actually slow you down in the long run and create more stagnation stages along the way. So, how does this happen? Well, due to inflation, the value of cash in your account diminishes year after year. Here's a calculator that shows you the impact of inflation on your savings over time. Now, let's say you have $5,000 in your bank account and you're not earning any interest. If inflation happens at a rate of 2.5% a year, which is pretty normal, in 20 years, your $5,000 will still look like $5,000 in your bank account, but it will only be able to buy the same amount of stuff as $3,051 could buy today. So even though the numbers don't change, the real value of your money shrinks because things get more expensive. That's why saving money in a way that grows over time is so important. So now let's compare that with a scenario where you invest your money. So if you were to invest that same $5,000 into something like the S&P 500 and average a 7% annual return adjusted for inflation, the estimated value of your money after 20 years would grow to over $20,000. However, it's important to note that there are no guarantees. Investment returns can go up and down, and past performance is not a guarantee of future results. So this really shows the power that compounding returns can have over time, instead of letting inflation eat away at your hard-earned cash. If you want to get involved with investing, then I'd recommend you download the Trading 212 app, where you can invest as little as £1 or euro to get started. Even if you manage to invest £5 or euros per day for the next few months, it will really help you get started with those first steps and break out of that stagnation stage. Since I was planning to talk about Trading 212 anyway, I reached out to them to see if they'd be interested in sponsoring this portion of the video. They agreed and are offering a free fractional share worth up to £100 to anyone that uses the code Tilbury when they create an account. Plus, you can get more free shares by inviting your friends. Both of you will get a free share as long as they fund their account. I'll leave a link in the description if you're interested. Just remember only to invest what you can afford to, and don't starve yourself of cash, as there's a lot we need to do in the next stage. Next is the acceleration stage. Now, this is where you're starting to gain some real momentum, but what got you here won't be enough to carry you to the next stage unless you want to wait decades to achieve financial freedom. This is the time to accelerate. You need to fully commit to taking advantage of current opportunities, as they won't be around forever. At this stage, there are 3 C's that I focused on, which helped me accelerate my wealth dramatically: cash flow, connections, and confidence. Let's start with cash flow. You need a constant supply of money coming into your bank account so that you can use it to generate more wealth. Think of cash flow as the fuel for your financial engine. The best way to generate cash flow is to start a side hustle that provides immediate income. This doesn't have to be your billion-dollar unicorn idea. It can be a small, service-based side hustle with low startup costs that meets a specific need. Whether it's
There'll be too much competition in the online space.
Well, teenagers have an advantage as they understand the online world better than anyone else. It's just second nature.
But Mark, I don't know what to do.
Well, that's why I'm going to be revealing the 7.5 best paid online jobs for teenagers. And this isn't any old list. For each one, I'm going to provide a real life example of a teenager currently killing it in that job. Job 1 is an advertising deal broker. Teenagers doing this job earn as much as $100,000 to $120,000 per year. In 2021, I bought a Tesla Model 3 and I set myself a bit of a challenge. I wanted to see if it was possible to use lots of different side hustles to earn back the price of the car. One of the ideas my son and I came up with was to get it wrapped like a race car, which would involve securing paid advertisements. At this point, we received a cold email from a teenager called Christian, completely out of the blue, who said that he was able to secure the sponsorship we required for a 30% commission. Christian managed to get an offer of $30,000 on the table. Had we accepted this deal, he would have made a sweet $9,000 for essentially matching us with the brand and acting as the middleman. In the end, Curtis managed to secure a different deal with public.com, so we went with them. However, Christian has managed to secure many of these deals in the past. That's why we can still offer you a free stock worth all the way up to $1,000 from Public with the link in the description. Christian told me that the best way to be successful with this job is to make friends in the right places. He described it a lot like a jungle, where one branch would lead to the next one and so on. Once you start working with one big company, it becomes a lot easier, as you can reference them as a past client and therefore demonstrate that you have experience in the areas that they require. So how does he do it? He uses different software to get the email addresses of influencers and just fires off messages until he gets a bite. Then he evaluates the needs of the clients that contact him back and runs a similar campaign focused on reaching out to brands on the influencer's behalf. It kind of reminds me of the book How to Win Friends and Influence People, where Dale Carnegie Carnegie talks about sending mail to powerful people and getting replies, only the modern day version. If we learn anything from Christian, it's the power of a good reference and relationships. Always do your best work because you never know where something might lead in the future. Job 2 is a Discord community manager for Web3. These teens make more than $70,000 a year, depending on their multitasking ability. When it comes to marketing for Gen Z, community is everything. Every brand under the sun is trying to build a community around their product. This is actually the main reason why Gymshark have set up their first store in London.
The real purpose of this store needs to be to really cultivate the Gymshark community and connect with people.
Now, if you've ever used Discord, then you've probably met a community manager. They're like the glue that holds everything together. I know a guy called Harry who hires community managers. He said that he wouldn't bat an eyelid at paying more than $2,000 per week if they were good at the job and represented the brand in a positive light. Additionally, if you're good at multitasking, there's nothing stopping you from being a community manager for 3 or 4 projects at the same time, which means big money. The job of the community manager is to be on the front line. You have to tell the story of the brand, be customer service and support, as well as supporting people when they're down and paying attention to global events. You need to be able to pause your schedule, be active when people are looking for you, and listen when people need your attention. Above all, you have to be the voice of the CEO, but not always speak on behalf of the company. Job 3 is writing scripts for content creators. These teens can earn upwards of $100,000, but can go a lot higher depending on the type of content and your experience. Words can make you sound smart, or they can do the opposite, depending on how they're deployed. That's why businesses hire copywriters, basically salesmen in print. Copywriters can make insane amounts of money. I'm talking over $500 an hour in many cases. It all depends on how good you are at making connections, your skill with words, and how fast you can write. Some charge as much as $50,000 for just one web page. You may be thinking, why so much? Well, it's all about value. If you charge $50,000 for a web page and it results in a business monthly profit going from $200,000 to $400,000, wouldn't you say it's worth it? It's all about leverage, making rich clients even richer, then asking for your slice of the pie. And it's not just websites either. People need quality writers for all sorts of things. Everything from TikTok scripts to threads on Twitter. Content is king, and the magician behind all of this is often the writer. I know a guy named Adam. He started off writing blog posts about his travels to earn passive income and live anywhere in the world. This later led him to working as a copywriter for large influencers. He followed the same strategy as Christian, got one client, which led to another, and so on. He told me when he offers a service, he always tries to be exclusive and do it in a way that no one else could. There's always going to be someone cheaper than you, but not always someone more expensive. Find the client who can afford to pay the premium, then learn to offer a world-class service. Job 4 is a SaaS software coder. These teens can earn between $60,000 and $80,000 a year. A guy called Sam King came on my podcast, Strike It Big, and explained how he built a multi-million-dollar business without ever having a normal job. Instead of building a traditional business, he decided to build a SaaS company. This stands for Software as a Service. Just think of how many online tools you use on a daily basis. I know I love Notion, MailChimp, Photoshop, and many. My boss asked if someone wanted to help install a staircase. When we got to the house, I was shocked. He had it all: granite countertops, Persian rugs, and a collection of supercars. I'd look out the window and see the owner relaxing or practicing his golf swing. When I talked to him, he only chatted about his personal hobbies and never his businesses. I asked him, "What's the secret to your success?" He tapped me on the shoulder and said, "Mark, if you can't make money while you sleep, you'll work until you die." This is now known in the modern day as passive income. That was the moment I decided I needed to join the top 1% of men. I'd like to retread my journey with you today. It's very clearly broken into 5 different stages, just like a video game, and at each individual stage I learned something imperative to my future success. You'll learn what I focused on as a hard-nosed businessman, what I obsessed about in the world of investing, and most importantly, the many mistakes I made along the way that have made me the successful person I am today. Stage 1, the awakening. This is when I went from zero to $20,000. My journey started as I emerged from my mother's womb, and my first words were, which stock should I buy? Just kidding. Like most people, I was pretty clueless about financial education as a kid, but I had the spirit of hustle in me. One of my earliest memories of entrepreneurship goes back to when I was selling fish door to door. Just imagine wiping the sleep dust out of your eyes at 4 in the morning, heading down to a freezing pier and sitting for hours until you'd caught enough mackerel to sell for a profit. Not only that, but grabbing a slimy fish from a bag, ringing a doorbell, looking a person straight in the eye and pitching to them. This built up my confidence and sales skills, two of the earliest skills I needed to learn to be successful. As I earned, I soon found that any money I made wasn't really mine. Instead, it would go to places like McDonald's and the girl I happened to be dating. I always seemed to have just enough. This is called lifestyle inflation, the tendency to spend more as you make more. Whatever you earn, it becomes your new baseline, and that's the trap. But being a car fanatic, I've always dreamed of owning a Ferrari. I felt as if they sent such a strong signal to others that you've made it. I'd often speak to my friend Paul, who worked as a valet parking cars for the rich and famous. He once told me something that changed my perspective on luxuries. He said, when people would drive up to the hotel in their Ferraris, they would watch me gawk and love every moment of it. I'm sure they felt admired, important, even respected. But actually, you know what, Mark? I didn't care about them or even notice them. Instead, I thought, wow, if I had that car, people would think I'm cool. And I wonder how many people buy these cars without realizing that people rarely give the driver a moment's thought. I learned that no one would be as impressed with my possessions and luxuries as much as me. People want to be respected and admired by others, but competence, intelligence, and kindness will bring you so much more respect than horsepower ever will. With all the information out there on the internet about how to make money or get rich quick, it can be hard to separate the truth from the marketing. Internet gurus have been getting wealthy for the past decade, telling other people how they can get rich, and there's a whole industry out there based on fantasy. But the truth is, wealth is not always what you see, but what you don't see. I decided instead I'd quietly follow my own path to wealth. But in order to do this, I needed a budget. A budget is knowing where your money will go versus where it went. Little by little, and for the first time, I started seeing my savings account go up. I started building an emergency fund, basically money for a rainy day. I didn't know exactly when or why it would rain, only that one day it would. One day, my boss approached me and ordered me to start making wooden trash cans. I made trash can after trash can. The hours would just crawl by so slowly. I went to my boss and asked him how long I'd have to keep doing this. Until the orders stopped coming in, which is probably never, he said, and I felt so deflated. Although I was saving money, I didn't feel passionate about what I was doing, but I wasn't thinking big enough. After all, I didn't care about luxuries, so why would I need more money? Then it hit me. I realised that control over your time is the greatest thing money can buy. If I had passive income, I could spend my time doing the things I really loved. The problem is, it takes a lot of time or money to start making enough passive income to become financially free. We spend thousands of hours every year working in the pursuit of money, so I asked myself, what was I truly passionate about? I had a burning passion for radio control models, and I noticed many people in this industry were making a lot of mistakes. I saw the true potential and the ways that I could improve on what had come before me. I once read in a book that if you could identify a problem and you had a better way of doing things, you could turn it into a business. Stage 2, the hustle. This is when I went from $20,000 to $100,000. So I got to work. I was so excited about my business plans that I shared them with a close friend and confidant, and to my shock, the unimaginable happened. He stole my idea and set up my entire business for himself. But before I get into that, first I'd like to thank today's sponsor, Public.com. Let's be honest, 2022 has been a pretty volatile year for the stock market, and that's exactly why our long-term sponsor, Public.com, wants to help you become a better investor. On Public, you can invest in individual stocks as well as ETFs, all the while learning from notable investors, analysts and top CEOs with their optional social features and town halls. My favourite thing about Public is they don't participate in payment for order flow by selling your trades to market makers, meaning they have no reason to incentivise you to trade more than necessary, like some other platforms do. On Public, you can invest, learn and see what top investors are doing all in one place. And the best part is, For a limited time, you can get a free stock worth between $3,000 and $1,000 with the link down below in the description. Anyway, back to the story. The reality is that I needed some money to pursue my dream, but my savings just weren't enough. I wasn't about to give up. I drew up a business plan, went to the bank and applied for my first loan. It wasn't easy and I had to visit multiple banks. However, eventually I secured the money I needed. While some people earn their wealth investing in the stock market, I reinvested the earnings from my businesses to open more stores and even buy back my original idea from my old friend. I started to know more and more people in the business world. A lot of these individuals became my mentors and would teach me things like how to build a business that scales, how to improve sales, and how to manage people. As my income grew and I solved problems, I was not only growing my net worth, but becoming a top 1% man as well. As the good times continued, I increasingly bet on them continuing, which led to one of my most significant life crashes and moments of despair. I remember it like it was yesterday, walking into the shop that I had initially started to give my father a job in his later years, and instead of being greeted by the magical emporium filled with all the toys that I could have only dreamed of having as a kid, I was met with a smashed roof, empty shelves, and my products laying broken, thrown across the floor. This hit me so hard that the memory has been seared into my subconscious, and I sometimes still see it when I close my eyes. You may think, it's all right, Mark, I know you, I bet you had insurance, everything was okay, and you bounced back. Well, in fact, I'd grown so fast and I was making so much money that not everything was correctly structured within my business. Although we were insured, I'd forgotten to update it with all the new stock that we'd acquired since the opening of the store. But the disaster doesn't stop there. It gets even worse. I got a phone call a few days later and one of my staff informed me that another 2 locations had been hit. Luckily, one of these attempts was unsuccessful on my flagship store as they couldn't break through the door. However, they'd driven a truck straight through the side of the store that was responsible for serving the entirety of London, and the damage was horrendous, let alone the stock that we lost. That's when I learned about the balance between risk and reward. See, making money requires taking risks, operating quickly and putting yourself out there. But keeping money requires the opposite. It requires humility and fear that what you've made can be taken away from you just like that. Once you lose 95% of your money, you have to gain 1,900% just to get back to where you started. Taking too much risk can bury you so deep in a hole, it can be nearly impossible to get out of. I even started to move my operations online to adapt to the changing times. Stage 3, the trap. This is when I went from $100,000 to $1 million. I realized that one of the biggest problems people face is when they turn their passion into a vehicle to accumulate money. They are now reliant on it to fund their lifestyle, leading to their passion becoming their prison. I mean, the biggest bottleneck in my business was actually the business owner, me. As the business got bigger and as we tried to move it online, so did the number of problems, complaints, and things to worry about.
Look, if anyone tells you that, never believe them. They're probably just trying to sell you one of those courses for $997. So even though there's no magic ball that can tell you when to buy a stock before it rockets in value and makes you a millionaire overnight, there is certainly a few things I do to tip the odds in my favour, and that's what I'd like to share with you guys today. As I've got older and slightly greyer, I've found that knowing the reasons behind why a stock might change in price has helped me make and save a lot of money. If you're new to the stock market, then a stock is a small part of a company, and when you buy it, you actually become a part owner. The idea is to buy parts of a company that you believe will go up in value so you're able to multiply your money without doing any extra work. But let's face it, investing in the stock market can be pretty confusing and most people just pick companies on a whim. However, that's not how I do it. So by the end of this video, you'll know my actual strategies for picking great stocks. And don't worry, I won't be trying to sell you anything, so you can just sit back and relax. So there are 2 main ways to attempt to predict the stock market. These are called technical and fundamental analysis. A good way to think about this is like a scale. Usually short-term day traders are purely focused on technical aspects. These include looking at charts and patterns. They believe that they can predict how the stock will change in price by judging the highs and the lows on the graphs. They're the geeky ones. Nah, I'm only kidding. It's just not how I do it. My whole investment strategy is about keeping it simple. Lots of people talk about using margin and options, but that's really not something I worry about. I'm a long-term investor, so this means I'm a lot more focused on the fundamentals of a company.
This includes the financials, the leadership and the brand recognition, as I believe this is where the information lies to indicate the long-term success of a stock. However, like I mentioned, it's a scale, so I do cast my eye over the occasional chart in order to find the best time to buy. This approach has helped me to find some really good investments over the years, rather than just dipping in and out and trying to make a profit on a daily basis. The amazing thing is the majority of professional traders are still unable to beat a low-cost index fund over the long term. This may sound quite complicated, but it's actually very simple.
So this bucket represents an individual stock, and the water is me pumping all of my money into that company. This represents an index fund, each cup being a different company. And the water I'm putting in is the money I'm spreading between each of them in one easy investment. For whatever reason, if this company goes bankrupt, then guess what? All my money goes down the drain. Now this is the same company and it still goes bankrupt. But the good thing is I may lose my money in that small investment. However, I've got so many more stocks and I've done really well in some of them, which means I've actually made a profit overall. My favourite index funds track the S&P 500, which are the top 500 public companies in the USA.
So even though the majority of my money goes into index fund investing, I also have a lot of fun picking individual stocks and watching my portfolio grow. On this note, if you'd like an easy way to get started, Public are currently giving away a free stock worth all the way up to $50 when you fund your account. If you want to pick that up, I'll leave a link in the description. And if you're in the UK, Free Trade are giving away a free stock that could be worth up to £200 when you deposit as little as £2. I'll leave that link below as well. It's a great way to get started with individual stocks and basically it's free money. Right, so now you got your free stock and you're ready to invest into some more. But where should you start? Well, if you're anything like me, it makes sense to start with the numbers. We call this quantitative analysis. Whenever I'm thinking about investing in a company, I make sure to look at all these figures first. If the financials don't look good to me, then it's very rare that I'll do any further research into the company. It's kind of like when you go on a first date with someone and they seem really nice. However, it isn't until you really start getting to know all the details about them that you might start to notice their flaws, like eating with their mouth open or picking their nose. If only they gave you a non-biased, comprehensive list of how they actually are, so you can make an educated decision whether you want to date them or not. I don't have a solution to this problem, but luckily that's exactly what companies do. It's brilliant. You can find out this information for free on Yahoo Finance, which is the website that I use. There are three main aspects that I look at. First, let's break down the balance sheet. I know it doesn't sound too interesting, but trust me, this is where you find some of the real juicy information. The whole purpose of this sheet is in the name, to balance assets and liabilities. Think of it a bit like this. You may own a watch or a rental property, and these are your assets. But let's say you have loads of credit card debt. This is one of your liabilities. So let's break down some of the gobbledygook terms so you can easily understand this complicated looking sheet and impress your friends. Assets are broken down into three categories. Current assets are things that can be turned into cash within 12 months. Longer term assets are things like their headquarters, which they usually don't sell in a hurry. Companies can also have assets that you can't physically touch, known as non-tangible assets, such as the brand recognition of an established business that has been trusted for generations. I like to think of Coca-Cola. And then we come to the liabilities, and what I'm really interested in here are the current liabilities, as this is the debt that they'll need to repay within 12 months. With this, there is a simple calculation you can do to easily know if the company is high risk or not, and that is total current assets divided by total current liabilities. A good rule of thumb here is the number should be above 1. But how does this work in practice? Let's take Apple's balance sheet for example. Apple's total current assets divided by their total current liability comes to 1.4 when rounded up. This is great, as now we know that Apple are able to pay off all their short-term debt nearly 1.5 times. The second document that's really important to have a look at is the income statement. If you've ever heard the saying of the top and bottom line, this is where it comes from. At the top of the statement, this is the total revenue, which is the total the business take, and at the bottom is the net income, which is the money the company makes after all the expenses have been deducted. Every business has these expenses, the cost of operation and the cost of revenue. So let's take a simple business like a smoothie company. Their cost of revenue is fruit. They can't make the smoothies without buying that. Therefore, that is a cost they have no choice about. It's a simple fact of running their business. But the next thing they do have a choice about, which is their operating expenses.
who they're hiring, and what kind of wages that they're paying them. After these expenses are deducted from the total amount of money they take from their customers, you get the operating income. So here's my simple calculation that lets me know if the business is healthy. Operating income divided by total revenue times 100. Ideally, I look for above 15%. Using Apple again, let's take this number, divide it by this number, and we get 27%, which is great. The last one of the big three is the statement of cash flow. I'm not going to spend too much time on this one, as when you boil it down, it's pretty simple. The main thing I look out for is if the company I'm investing in has increasing free cash flow year on year, which is money they can use to reinvest or pay back to investors. A big red flag here is sometimes I see the cash flow is negative, but the company is still paying dividends back to its investors. It's just unsustainable, and eventually the business is just going to run out of cash. Now, once I've had a good look at all these numbers, it's time to get into the juicy stuff, and that's all about analysing the qualities of a company. This is known as qualitative analysis. One of the qualities I look for is brand recognition. When I say the word Apple, most people think about the company rather than the fruit. I know I keep referring to it, but it's a great example of amazing brand recognition that won't be going away anytime soon. Being a household brand name comes with a lot of consumer trust, so when they launch a new product, people are much more likely to try it out, especially if it's something unique or groundbreaking, such as the iPad.
And we'd like to show it to you today for the first time. And we call it the iPad.
This helps companies like Apple shape
To start investing all over again, I'll do things a little bit differently. So if you can follow all 5 of these steps, then you'll be well ahead of me when you get to my age. Step 1, adjust your risk tolerance. In hindsight, I realised that I may not have taken as many risks as I could have during my younger years. The reality is that in your 20s, you typically have more time than money. This means that any risks you take have minimal downsides compared to those that have families and a mortgage. This is the time to build your empire, so being scared of taking risks is actually the most dangerous thing of all, as it means you'll fall short of your full potential. Of course, you should do everything in your power to swing the odds in your favour. However, you won't be able to eliminate risk entirely if you want to become wealthy. There is still going to be some risk in every opportunity, as nothing good ever comes easy. When times are hard, people are much more likely to let that little bit of doubt get inside their head and talk them out of whatever they want to do. I've seen countless friends say they're going to quit their job to start a business, but they never make that leap because they don't want to risk their comfortable income. When I'm judging whether or not to make an investment, I compare the potential risk with the opportunity cost of not taking that risk. Opportunity cost is what you give up when you choose one option over another. Thinking about this helps you make better decisions about how you use your resources. I'm not saying I always make the right decisions, but on average, I've come out profitable when I've used this tactic, and I also never want the thought of what could have been eating away at me. So the best way for you to grow your wealth is to take calculated risk with your money and use that time to grow your wealth faster than everyone else. Step 2, set it and forget it. I definitely should have automated my investments a lot sooner, as it forces you to prioritize your investments as the money is taken before you can spend it. This is when you arrange to have a fixed amount of money taken out of your paycheck or bank account every month and put into a predetermined investment. Investing $100 in an S&P 500 index fund is a good example of this. This will allow your wealth to compound over the years without you ever having to really think about it. This is a very straightforward process. First, determine how much money you want to save and from which account. Then go to an investment app and look for an automatic investment option and choose how you want to invest. They'll do all the paperwork. Once you sign off on the bottom line, the automated magic begins. In my experience, the majority of people that lose money when investing waste their time trying to pick the right stock at the right time. And if you've been watching my channel long enough, you'll already know that it's not easy to time the market. For me, investing is all about growing your money over the long term. ETFs allow you to invest in an entire market quickly and in a single transaction by tracking the performance of an index. You can choose to invest in specific regions like the top 500 companies in America with the S&P 500, the entire stock market, or even specific sectors like tech. InvestEngine is a which recommended provider and is a platform that really resonates with me as their entire focus is on long-term ETF investing. They offer ISAs, which are essentially fortified investing accounts protecting you from taxes. Because no one likes the tax man. With ISA accounts, you can only invest £20,000 per year, but any profits you make can be withdrawn completely tax-free. So I definitely recommend creating an ISA account with them and protecting your returns. If you sign up to InvestEngine today using my link, you'll receive a £25 welcome bonus when you invest your first £100. So you can get a 25% return on your money from the start. They even have an auto invest feature, which invests any cash that hits your portfolio straight into the ETFs you pick. So you really can set it and forget it. Thanks InvestEngine for sponsoring this portion of the video. Step 3, avoid temptation. I understand why people were drawn into the crazy crypto investments a couple of years ago, as this was similar to penny stocks back in my day. When there's a craze like this happening, lots of people feel like if they don't invest, they'll lose out on an amazing opportunity. So they start investing in things without fully understanding them. This has to be one of the most risky things that you could ever do, and it's probably the biggest investing mistake I see people making. I speak from experience. I made a few lucky investments in penny stocks when I was younger, and had I continued on that path, I would have lost everything. To be more exact, I had the opportunity to invest in a big group with a couple of billionaire friends. Everything they touched seemed to turn to gold. I can't reveal